How do you evaluate a deal in the private capital markets, whether it's a business that you are acquiring to operate or it's an LP investment, either in private credit, real estate, or private equity? Like, how do you think through whether this is a good opportunity or not? And today, what we're going to do is we're going to walk through a case study of one of our live deals that's out there now and run it through my growth predictor framework that we've done on this channel a couple of times with other opportunities. My name is Walker Dybel. I am the Wall Street Journal bestselling author of Buy Then Build, creator of Acquisition Lab. I've been acquiring small businesses since 2006. I launched the entrepreneurship through acquisition program at the Olin School of Business, and I created Acquisition Lab, which is the premier accelerator for people wanting to buy businesses, where we've helped hundreds of people acquire almost $500 million in small business transactions for themselves. I also run Build Wealth, where we've raised about $23.5 million over the last 12 months across private credit, private real estate, and private equity, as well as oil and gas, in order to help build a sort of like communal family office for normal, everyday accredited investors. And what I do with the growth predictor framework is I sort of use this framework to run through all of the parts of a deal to see if it's something that I want to invest in. Okay. And so what we're going to start with here is just the offer. I always start over here and I think about what the offer is. In this particular case, we're going to talk about the legacy fund. I worked this deal with Kyle Howerton, the managing partner of AHM, in order to create it specifically for our community. Okay, this is a deal that's not available anywhere else. What this offering is it's basically a portfolio and a strategic expansion within a dedicated neighborhood inside St. Louis, Missouri. Okay, so the offering starts with 11 seed properties, and then those are acquired for $4.5 million. The seller took 40 years to acquire the initial 11 seed properties, and he is rolling $8.3 million of preferred equity into the deal. Okay, what that means is that we get to buy $27 million just in seed properties for $4.5 million of equity. Okay, called it the legacy fund because we're building our legacy, but we're also carrying the torch for this seller, and he hand selected AHM and based on their performance, their values, how they work. And so it's one of these where we're able to carry his legacy forward in order to, fulfill his ultimate dream of elevating the Central West End, which was where he was born. Kyle Howerton also lives in the Central West End. It's a very unique neighborhood, right? This is a very walkable neighborhood with world-class restaurants. It's directly across the street from the largest city park in the entire country, in Forest Park. And the majority of these buildings were built right around 1900, right? So the architecture is just beautiful. A lot of the new buildings that have gone in are, very impressive modern skyscrapers, and it's a very special neighborhood. Okay, 5,000 people that come in on transit. There's over 20,000 cars. There's 16,500 people that live in the Central West End neighborhood. And ultimately, at the bottom line is that you've got 40,000 daily visitors into this neighborhood. It's a very urban, bustling neighborhood, and this offer is that on the first day, we're moving in and acquiring these 11 seed properties that make it so that we are immediately the largest real estate owner in the Central West End. That's attractive. We've got a full off-market pipeline of buildings that are almost touching ours, so that we can acquire, own, and elevate, the entire neighborhood. It's a very compelling offer. I think the thing that catches most people is that it's a 10-year lockup, okay? And I want to talk about that for a minute because it is, at first glance, a drawback, and it's a reason to maybe not do it. But what makes this offer so interesting is that it's not a normal real estate syndication offer. When you look at a traditional syndication route, right? You invest money, call it $100,000 in a real estate syndication, and then it runs for 3 to 5 years. Usually the first year and a half, you make no money. Then once it stabilizes, the sponsor will typically start paying out, call it 4, 6, maybe 8% cash on cash returns while you build until exit, where you're hoping to get like a 1.5 to 2x multiple on that original $100,000, right? Then you've got some downtime. You've got to find another syndication. Maybe you're lucky enough to get a 1031 exchange so that you don't have to pay taxes, which would, cut that significantly down, and then you could roll it forward. And then, of course, you're doing patient again, waiting for your 6% cash on cash. Guys, when you look at the 10-year hold, it way outperforms the normal syndication timeline. And the reason is because by the time the base case projections, by the time you get to the end of year 5, intrinsically, the value of your equity is essentially tripled, if not more, because starting in year 6, you're getting 20% cash on cash returns all the way through the end of the life of the fund, at which point they're projecting a 5x multiple on the exit. And the reason, and by the way, you don't wait 5 years to get cash. I think it starts cash flowing in year 3. And then, year 4, you get 12%. Year 5 is 15%. You're already outperforming other syndications, and your internal equity is worth more than, even the 2x, equity multiple in a normal syndication. It's worth about 35% more. Then you don't have no downtime. The portfolio continues to compound. And so you get 2 cycles or 2.5 cycles all in one. Okay. That's what this is doing. It's capitalizing on a very unique opportunity in the market, in the world, in the neighborhood. Let's talk about demand for a minute. And I think that, so the offering I like it a lot. It's mixed use, they're placemaking, it's a very, we actually engineered it directly for our audience, right? And so it's, if you look at demand, there's 2 major, economic drivers directly in the neighborhood, okay? Right there on Forest Park Parkway. And one is Barnes Jewish, okay? And Barnes Jewish is the hospital that's attached to Washington University in St. Louis, my alma mater, which is actually the #1 ranked medical school in the country, and which is just on the other side of Forest Park from the Central West End. They employ 20,000 people and have 2,000 residents right there in the Central West End. On top of that, they also manage $1 billion in foundation money annually, okay? And so the second piece is you have the Cortex, which is just neighboring over to the east. The Cortex generates $2.1 billion a year annually. It's invested $1 billion in infrastructure on the south side of the Central West End. And you have to understand, this is a vibrant place, lots of restaurants, lots of cafes, obviously a hospital, places to work, places to live, all the rest of it. And, ultimately, though, what you need to understand is that it's currently at 97% occupancy. And, like the most recent builds in this neighborhood have been luxury. And the reason for that is because the average age of all the people moving through the Central West End is 39 years old, okay? And the people who live there and work there have a higher than average education and a higher than average income, okay? And so what they really want is this live, work, play neighborhood where they're able to, rent apartments that are really nice places to live and just sort of, have this walkable neighborhood, where they can, hit the cafe, hit the gym, go to a restaurant, do luxury shopping, go to Forest Park and play golf or whatever you want to do. And that's what they want, right? And that's the demand that's happening here. And there's nowhere to live right now because it's 97% occupied. And not only that, but there's fewer starts to current inventory in St. Louis than almost anywhere else in the country. I've personally seen private equity money coming into St. Louis, specifically the Central West End, for that reason. So this is a really unique and interesting demand. And, if you know anything about how I invest and what I look for at Build Wealth Funds, I'm always looking for that supply, demand, and balance, because that's the benefit that private markets offer. That's the, the inefficiency that you can't necessarily capture. We're looking for entrepreneurs working, at the top of their game in their line of expertise and executing on deals with supply, demand, and balance, in my opinion, just like this, okay? From there, I go to money, okay? And so this is a pretty, how does this thing make money? And it's actually pretty simple. On the first floor commercial, what you're going to find is the average lease is 27 years old in place. People don't move once they get in there. We are buying all 4 corners of one of the major intersections of this neighborhood. We have 6 restaurants on it. So where do you think these 40,000 daily visitors go to lunch? Right? They go directly to our corner, okay? So these are long-term commercial tenants that want to be there. Further, when you look at the fund and you understand how it makes money, sure, we're using a lot of leverage and we're getting the benefits of building up equity. But there's a couple of things that are super interesting. Of the 11 initial seed properties, 8 of them have immediate increase in revenue opportunities, okay? There's 3 properties that the team is hoping to close on in very short order after the fundraise is closed. Here's one of the most interesting opportunities. We are buying the last 1.1 acres of developable land in central corridor of Central West End. AHM has a ground-up construction partner as well as team internal to the company. The LP investors in this fund come into this ground-up opportunity as a co-GP, so they get all the GP returns without any of the active work nor any of the personal guarantees required. So that's super, super compelling. From there, I go from how does this thing make money all the way down to, how do the investors make money? Okay. And again, in this particular case, it's actually very simple. There's huge intrinsic value with what's being underwritten here in terms of, building a portfolio and elevating the neighborhood. By the way, I've said it before, lower interest rates and elevating the neighborhood successfully are not part of the underwritten model. However, it's exactly what AHM has done 3 times before in different neighborhoods. Okay. So this is all about how do investors make money? How do we get paid? I kind of talked about the stock market comparison, the other syndication comparison. This is simply, building a portfolio, a real estate portfolio in a very high demand neighborhood, elevating it, increasing revenue, and then paying out investors. Ultimately, it's underwritten as an exit. And so, because this is sub-institutional, AHM is going to have the opportunity to either sell it all as one big package to an institutional buyer or simply break it out into parts and sell it that way, depending on which one is going to be, the most lucrative for investors. And what I like about it is, the initiative around the deal is that it's all about total maximum value over an entire decade. This is truly a family office engineered opportunity that is not available to normal everyday accredited investors that we built specifically for our group. Okay, so that's cool. I do also look for co-alignment. The GPs at AHM are investing in this deal as well as myself. I always invest in everything that I take out through Build Wealth. Okay, now let's talk about the team. Look, I've talked about AHM and their team extensively. If you jump in the portal, you can see there's 8 reasons, going through their entire approach. They're very strategic. Number one, they don't look for a good deal. Okay, this isn't like I found a good deal, let's go syndicate the deal. AHM tackles entire neighborhoods. They're focused on 3 or 4 neighborhoods in the Metro St. Louis area, all of which are very close together. And every single neighborhood in which they operate, they're the single largest real estate owner. Further, they believe, and I believe, that information is knowledge and knowledge is edge. And as a result, they know what all the rents are. They know, they currently have, over 900 apartments. They currently have over 250,000 in commercial square feet that they manage. They're vertically integrated, so they have property management, but they don't run property management for a profit. They run it at break even and keep all of their value as well as all of our value as investors into the real estate asset itself. Okay. They also have capital markets knowledge. They also have ground up knowledge. They also have value add knowledge. And when they move into a neighborhood, their strategy is to do both value add projects as well as ground up projects. Value add for the sort of, quicker, I'll call it midterm, sort of, 3 to 5 year, and immediate cash flow. So immediate cash flow to fund 3 to 5 year bumps in terms of, getting assets upgraded and stabilized. And then they also add ground up around it in order to get that sort of generational wealth pop. And this is the first time that all of those things exist in one neighborhood, in one fund at ground level right here. Okay, then lastly, I move to momentum and transformation. Okay, and so I'm looking at the team, I'm looking at the neighborhood in this case, right? And so again, like AHM has this strategy that they've already played out in the Grove, in Tower Grove South, currently in downtown West. AHM bought 12 urban acres next to the new stadium, and they've been building and developing. We've brought in millions of dollars. They brought in millions of dollars in order to develop this whole space, and we can see that by the end of this year, we already know that there are hundreds of new jobs already moving to the block that we are building on right there. And so it's very exciting to see the way that AHM works. Now, to date, it's been all about revitalizing entire neighborhoods with good infrastructure and good economic drivers. This one is different because there's such a huge existing demand with a ton of momentum and transformation that's been happening over a number of years. And so ultimately, this is what gives AHM the edge. Like, why would we pick them? Why would we go with them? What do they know? On day one, they're going to own more real estate than anyone else. Okay, they're vertically integrated. They're going to have all the information. They already have an extensive pipeline of, off-market deals ready to go and ready to sell. And there's a placemaking strategy in place based on all the information that we already have. I think the 4 partners of AHM, if you add them all up, I think they have like 80 years in real estate, active management in real estate, and it's something that I've seen firsthand on the ground. If you don't know St. Louis, it's flyover territory. for a lot of people, and that's actually what is the opportunity here, okay? Because St. Louis is ripe. Okay, there is so much opportunity in St. Louis that, you know, if AHM was able to pull in 100 million a year for 5 years, they couldn't exhaust it. They couldn't even halfway exhaust it, right? So there's a ton of opportunity here because no one else is doing what they're doing in this market. That's what makes it super exciting. So this is the growth predictor framework. I hope you enjoyed this. It's just sort of a model that I use to kind of run through the fundamentals in a deal and see, you know, if it makes sense, if it's aligned, if it has all the pieces. And this is how I kind of put together the business model and think through whether I want to invest in something or not. If you are interested in, you know, checking out this deal, check out the PPM, please look at all the risks, all the whatever. You know, I can't give financial advice, all the other disclaimers I could give you right now. The point is Build Wealth is all about, you know, me finding and negotiating deals that I want to invest my own money in and inviting our community in, because I want to build a family office of accredited investors so that we together can get the same deals as these, you know, much more significant wealthy families ahead of us. So if you are an accredited investor looking to bridge that, you know, 1 to 5 million to 20 million, check out buildwealth.com, and we'll see you on the inside.